Hello guys, good day. Welcome to our first video lecture in ACC 221 Intermediate Accounting 3. In this video lecture, we will be discussing about share-based compensation plan, particularly share-based compensation through share options. By the way, I am your lecturer, Sir Zhao. Alright, to start our discussion, let us explain first the concept of share-based compensation plan. So when we talk about share-based compensation plan, it is an agreement established by the entity whereby the entity's employee shall receive shares of capital in exchange for their services, or the entity incurs liabilities to the employees in amounts based on the price of its shares. So other than the cash compensation that is received by the employees, this share-based compensation plan is another way of compensating these employees. And normally, these compensation plans are common to employee remuneration for directors, senior executives, and other key employees. And usually, it is tied to performance in a strategy that uses compensation to motivate the recipients. So, share-based compensation usually is considered as a tool in order to entice or to encourage these employees to do more or to do good in their job in order for them to generate more share-based compensation. Okay? So, talking about share-based compensation plan, so PFRS 2 sets out the measurement principles and specific requirements for accounting of the following share-based compensation. So, talking about share-based compensation, we have two two ways on settling this share-based compensation. Number one is your equity settled. So, this is the subject matter of our video lecture through share options. So when we talk about equity settled, it is the entity issuing equity instruments in consideration for services received, for example, as what I have mentioned, through share options. Okay, so this will be our focus in our discussion for this video lecture. In the next video lecture, we will divert it with another share-based payment through cash settled, where the entity incurs liability for services received and the liability is based on the entity's equity instruments, for example, share appreciation rights. So again, as what I have mentioned earlier, that share-based compensation will have two types. It's either equity settled or cash settled. So in this lecture, let us focus our attention first with share options, or when the compensation is equity settled. So there is share options. It is granted to officers and key employees to enable them to acquire shares of the entity during a specified period upon fulfillment of a certain conditions at a specified price. So these options are conceived as additional compensation on the part of senior officers and other key employees. So the rationale of share options is that share options will be given to these officers or employees for every time they have rendered to the company. And these share options will give them the right or give them the opportunity to buy shares of the entity at a relatively lower price compared with the usual offering of such price to the public. So that means if you are an officer or if you are an employee of that corporation having a share options, then therefore, once you have that share options, you can now buy the company's share at a lower price compared when it is regularly offered to the public, as what I have mentioned earlier. So, in this case, our dilemma, no, the accounting problem when tackling about share options is first, how are we going to measure the compensation? And second is when are we going to recognize such compensation? So in this case, as what I have mentioned earlier, when there is a share options is considered as an additional compensation to the recipient. But again, the problem is that how much will be recognized as a compensation and when are we going to recognize such amount as a compensation. So the standard has actually given us guidelines on how are we going to measure share options. So we have two measurement methods. Number one is your fair value method. Your fair value method, it's the compensation equal to the fair value of the share options on the date of grant. Okay? So your compensation will be equal to the fair value of your share options on the date of grant. Okay? So the first question as to how much compensation will be measured or will be recognized is already answered. It is equal to the fair value of the share options on the date of grant. Okay? And take note, guys, the standard, particularly PFRS2, is actually um, mandating the practitioners to use this method in accounting for share options. Okay, so if the problem is silent as to which method will be used, either fair value method or the intrinsic value method, then therefore we will use fair value method because it is what is mandated by the standard. Okay, however, we also have this intrinsic value method. So intrinsic value method, it is the compensation equal to the intrinsic value of the share. So usually guys, intrinsic value method will be used when the fair value of the share options cannot be reliably measured, okay? Or there are no information about the fair value of the share options. So that's the time when you will be using the intrinsic value method. So paragraph 24 of PFRS 2 provides that this can only be used again if the fair value of the option cannot be used. So we have there your guidelines to compute for our intrinsic value, where intrinsic value is equal to the market price minus your option price. Okay? Intrinsic value is equal to market price minus option price. Okay? So that's the first concern, no? Our first question earlier is how much will be measured as a compensation or how much will be recognized as compensation. So we have already answered. So it's either you use fair value method or you use intrinsic value method. So again, when the problem is silent and when the fair value of your share options can really be reliably estimated or is already given, then you use fair value method, okay, on the date of grant. While on the other hand, if the circumstance would not give us the fair amount of the fair value, then therefore we can opt to use your intrinsic value. Okay, now this time let us try to answer our second accounting problem earlier, which is pertaining to the timing, no? As to when are we going to recognize such compensation. Okay, so if the share options vests immediately, okay, so um, there are two important points that we need to consider in accounting your share options. Either it vests immediately or it does not vest immediately. So when the share options vest immediately, okay, the employee is not required when okay when when the share options vest immediately, it means that the employee is not required anymore to complete a specified period of service before unconditionally entitled to the share options. Okay, so that means when it vests immediately, for example, the employee would no longer um, be required to work for example, at least 3 years or at least 2 years before a particular employee would be entitled to receive a share option if that is a share option that vests immediately. Okay, so the employee will no longer wait for that rendering of time or rendering of service for that corporation. When that is actually is the case, the entity shall recognize the services received in full with a corresponding increase in equity. Okay? So that means when the share options vests immediately, the corporation on grant date the entity shall recognize the compensation as expenses in full with corresponding increase in equity. So that means if the share options vest immediately, then therefore the answer to the question as to the timing will be on grant date, no? If it vests immediately, the it it if the share options vests immediately, then therefore directly on the grant date, the entity shall recognize the compensation as expense. Okay? On the date the share options was granted, then therefore that's also the time where compensation expenses will be recognized if it is actually vests immediately. Pero on the other hand, if the share options do not vest immediately, so that means opposite siya ni vest immediately earlier. If it does not vest immediately, then therefore that means the employee needs to complete a specified service period. Okay? Alright, the compensation is recognized as expense over the service period or vesting period, meaning from the date of grant to date on which the options can first be exercised. Okay? This is on the theory that the share options are in recognition for services rendered between the date of grant and the exercise date. So that means if it do not vest immediately, then therefore we need to um, recognize the compensation expense on a staggered basis. Okay? So do not worry guys, because in the succeeding slides we will have sample illustrations when we are going to use vest immediately or does not vest immediately. For example, let's say an illustration pertaining to no vesting period. Again, when there is no vesting period, then that means it vests immediately. Okay? So, first question, accounting problem is that how much compensation expense will be recognized? Then our answer would be equal to the fair value of the share options on the date of grant. Second accounting problem, when are we going to recognize compensation expense? When the problem is no vesting period, or if the share option vests immediately, then therefore on grant date. Okay? On grant date, we will already recognize your compensation expense. Okay? Or we will already recognize your expenses. For example, on January 1, 2019, share options are granted to employees to purchase 100,000 ordinary shares of 50 pesos par value at 60 pesos per share. Okay? On this date, the fair value of each share option is 20 pesos. Okay? The options are exercisable immediately. So that means it does not, or it vests immediately. So that means employees will not be required to render services a specific amount or length of time of employment before they are going to be entitled to receive these share options. And the employees moreover exercised all their share options on December 31, 2019. Okay? So we have here the grant date on January 1, 2019 and the exercise date on December 31, 2019. So before we do the journal entries, let us analyze first the problem. Okay? On January 1, the entity granted share options. As what I have told you earlier, guys, that share options, it's the opportunity given by the corporation to these recipients of these share options to buy shares that is relatively lower compared when it is offered regularly to the public. So when the share options are exercised, they will be paying 60 pesos per share for a 50 pesos par value. Okay? So maybe when it is offered in the public, no, maybe the issue price will be more than 60 pesos. But because of that share option, the employees or the recipients or the holders of these share options can only pay or can only acquire such shares, ordinary shares, for only 60 pesos. Okay? The employees daw were able to um, exercise this on December 31, 2019. So therefore, again, um, as to the amount of the compensation expense that will be recognized, it will be equal to the fair value. Okay? So the fair value of the share option is 20 pesos. How many shares or how many share options that has been granted? 100,000. So therefore, the total compensation that will be recognized will be 100,000 times 20 pesos na fair value. Okay? First question earlier, how much? So how much will be equal to the total number of share options times the fair value. We have the fair value of 20 pesos times total number of share options na 100,000. So therefore, the total amount to be recognized will be 2 million pesos. Okay? Second question, how much? Okay, how much? Since the problem is exercisable immediately, then therefore, on the grant date din mismo, okay, on the grant date din mismo on January 1, 2019 is the timing where you will be recording that salaries as salaries expense. So that is why on January 1, 2019, your journal entry to record your compensation compensation expense or your share-based compensation will be salaries through share options for 2 million and then credit to share options outstanding for 2 million also. And then on December 31, okay, on December 31, your share options were exercised. So that means it's the time where your recipients of that share options has exercised that share options. That means they have used that share options to buy that shares on a stipulated price earlier, which is 60 pesos. So in this case, the corporation will now be receiving 100,000 times 60 pesos because the issue price is 60 pesos. So 100,000 shares times 60 pesos. So the issue price will be 6 million. Okay. And then credit to another debit to share options outstanding. Debit to share options outstanding for 2 million to close out your share options outstanding. Okay? And then credit to ordinary share capital. So ordinary share capital, this is equal to the par value. As we all know, par value of 50 pesos times number of shares issued na 100,000. So we have 5 million pesos here. And then credit to share premium. So we have a total of 8 million versus 5 million, then therefore your share premium will be 3 million. Okay? So on December 31, this will be your pro forma journal entry. Okay? Anyways, guys, for your information, these share options outstanding or SOS, this is considered as a component of your share premium. Okay? This is a component of your share premium. So, sir, what will happen if on December 31, 2019, the recipients of that or the holders of the share options weren't able to exercise the share options? So, in that case, then that means wala'y ma-receive na cash si corporation and then wala din siyang i-issue na ordinary share capital. But what will happen to our share options outstanding? Since it will be of no use, then it will be credited to share premium. Okay? It will be reclassified to share premium. So that is why if let us say hypothetically the holders of the share options weren't able to exercise. So your journal entry on December 31, 2019 to close these share options outstanding of 2 million will be debit to share options outstanding for 2 million and then credit to share premium for 2 million also. If ever the holders were not able to exercise their share options. Okay? So as simple as this, no? When the transaction is including an exercisable immediately na share options or in short, it vests immediately or with no vesting period. Okay? So let's continue. What if there is a vesting period this time? Okay? So same accounting, it's just that the timing this time will now change because it already includes a vesting period. Okay? What's the standard? What does the standard state regarding the timing as to your share options with vesting period? it will be recognized from the date of grant to the date on which the options can be first exercised. So that means your salaries expense or your compensation expense will be reported on a staggered basis. Unlike earlier, kapag no vesting period, entirely your compensation expense will be recognized on the grant date. But this time, since we have vesting period man, then your salaries expense will be recognized staggered from from starting from the date of grant or the grant date up to the date where it is available for exercise. Okay? Example, on January 1, 2019, share options are granted to employees to purchase 100,000 ordinary shares of 50 pesos par value at 60 pesos per share. So just like the same with the previous problem. On this date, the fair value of each share option is 15 pesos. Okay? So as to how much, then therefore, we will use the fair value since fair value is given 15 pesos. The officers are entitled to the share options only after completing 2 years. So that means they will only be entitled to receive these share options 2 years, no? After 2 years. And the options can be exercised starting January 1, 2021 and will expire 1 year after. So it also includes an expiration date. That means from January 1, 2021, if they weren't able to exercise it after 1 year, then therefore it will also be expired. Okay? So just like what I have told you earlier, when your share options were expired, so such share options outstanding will be credited to share premium, 'di ba? Okay. So example, let us compute first with the total compensation to be recognized. So the total compensation will just be same computation earlier. So we have the total number of shares or share options, 100,000 times your fair value na 15 pesos. So 100,000 times 15 pesos, so you have 1.5 million. But since it has vesting period, then you need to divide it for 2 years. Okay? Staggered ni mo siya every year. So since ang vesting period lang man is 2 years, then therefore you divide it only for 2 years. So that means your annual compensation will be 750,000 from 1.5 million divided by 2 years. So on December 31 of 2019, your journal entry to recognize your compensation expense or your salaries expense will be debit to salaries, share options for 750,000, and then credit to share options outstanding for 750,000 also. Same entry will be recognized on 2020. Okay? Pero take note guys, the recipients or the employees can only or are only allowed to exercise it starting January 1, 2021. Okay? Pero actually, the employees were able to exercise it on December 31 pa lang. So, your journal entry pagka December 31 on the exercise date will be debit to cash for the issue price of 60 pesos. So, 100,000 times 60 pesos, so you have 6 million. And then credit to another debit for share options outstanding for 750 pesos plus 750 for 2020. So you have a total of 1.5 million. So credit to ordinary share capital for 5 million. So where did we get this 5 million? This is from 100,000 shares times your par value of 50 pesos. So we have a total of 5 million. And then credit to share premium, which is the difference of your 7.5 million minus 5 million na ordinary share capital. So we have a share premium of 2.5 million. Okay? So this will be your pro forma journal entry when the transaction is actually indicating a vesting period. Okay? So balik tayo sa sinabi ko kanina na what if nag-expire, no? Because it is only exercisable for 1 year. What if December 31, 2021 has lapsed and then the the recipient weren't able to, weren't able to exercise it. So that means these share options, okay, these 750 plus 750 or a total of 1.5 million na share options will then be credited to share premium. Okay? So to close it, after the lapse of that moratorium or ultimatum for them to recognize or to exercise that, so debit to share options outstanding for 1.5 million and then credit to share premium for 1.5 million also. So if ever wala siya na exercise. Okay? So that's technically how are we going to account no your compensation, share-based compensation through share options. So there are two things that we need to consider. First, again, I'd like to reiterate this with you guys. Number one is the timing, okay, and the amount. First, the amount. So the amount of compensation that will be recognized, it will always be equal to the fair value of the share options on the grant date. Okay? And then as to timing, then if it does not vest or it has no vesting period, then immediately on the grant date, you recognize that as compensation expense. Pero if it has vesting period, then therefore you will you will recognize compensation expense on a staggered basis. Okay? So up until available na ang share options for exercise. Okay? So let's proceed with another illustration, this time with an upgraded na circumstance. What if there are some employees who left the corporation? Okay, how does this um, leaving of the employees would affect the computation of your compensation expense? So let us say on January 1, 2019, an entity granted 100 share options each to 500 employees, conditional upon the employees remaining in the entity's employ during the vesting period. So, needless to say, this problem includes a vesting period. Okay? There is a vesting period here. The share option vests at the end of a 3-year period. Okay? So, highlight this one, 3-year period. So, therefore, when you compute for or when you account for the timing, okay, your compensation expense will be divided into 3 years. Okay? On grant date, each share option has a fair value of 30 pesos. Okay, 30 pesos. So in this case, by December 31, 2019, 30 employees have left, and it is expected that on the basis of a weighted average probability, a further 30 employees will leave during the vesting period. So obviously, guys, when employees leave the corporation, then that means the total number of employees who will be eligible to receive share options will now be reduced. So that means that your share options to be distributed will also be reduced, and eventually the total compensation expense that will be recognized by the corporation will also be reduced. Okay? So same happened on December 31, 2020. So 28 employees have left, and the entity still expects for a further 25 employees leaving for 2021. And on 2021, 22 employees actually left the corporation, thus giving the corporation a total number of 420 employees who are eligible to receive share options at the end of 2021. Okay, so let us account how much is to be recognized as compensation expense every year from 2019, 2020, and 2021. Okay, so let's start with 2019. So there are originally 500 employees. Okay, 400 employees. So less those who leave in 2019, or those who left in 2019, 30 employees, and those expected to leave pa in the remaining years up until the the vesting period of 30 more employees, then therefore employees entitled to share options will now be 440 using the assumptions sa 2019. So 440 times the total number of share options to be distributed per employee. So it's assumed that each employee will be receiving 100 share options. So for 40 times 100, so in 2019 alone, the total expected share options to be distributed will be 44,000. So 44,000 times the fair value of your share options na 30 pesos. So therefore, your total compensation will be 1,320,000. Pero again guys, since the problem is with vesting period, so that means this 1,320,000 will be recognized for a 3-year period also. So to compute for your compensation expense for 2019, you need to divide it by 3 years. So we have 1,320,000 divided by 3 years. So your compensation expense for 2019 will be 440,000. So on December 31, 2019, your journal entry will be debit to salaries, share options for 440,000 and then credit to share options outstanding for 440,000 also. Okay? So that is for 2019. Now, let us account for 2020 as well. Okay, what happened in 2020? In 2020, so there are still originally 500 minus the number of employees who left in 2019 and then those who actually left also in 2020, which is 28 lang. Okay? And then as per assumption, there will be another 25 employees who will be leaving for the next year before the share options can be exercised. So that means that leaves the corporation a total of 417 employees entitled to receive share options. Okay? From these 417, you multiply it by the total number of share options that and every employee could receive. So the total share options to be distributed will be 41,700. So 41,700, multiply it again by 30 pesos, which is your fair value. So your total compensation will be 1,251,000. So 1,250,000, that is for the entire 3 years. Okay? But take note, guys, we already had recognized some portion of it in 2019. Okay? So in this case, to compute for the compensation expense in 2020 alone, we need to divide this by 3 years. 1,251,000 divide 3 years and then multiply it by 2 years to compute for your cumulative compensation for December 31, 2020. So that gives us 834. So this 834 is your again cumulative compensation up to December 31, 2020. That means since it is cumulative, it already includes the compensation expense that we have recognized last year, 2019, in the amount of 440. So simply stated that the amount to be recognized as your compensation expense for 2020 will be 394,000. Okay? 394,000. So on December 31, 2020, your journal entry to recognize your compensation expense would include debit to your salaries, share options, 394,000, credit to share options outstanding for another 394,000. Okay? So let's proceed with next year, 2021, the last year before the share options can be readily be exercised. So from actual numbers of employees who left the corporation, 30 in 2019, 28 in 2020, and 22 on 2021. Okay? Sir, why is it that in 2020 we recognize 25 number of employees who are leaving. Pero in 2021, we only recognize 22. Take note guys that in 2020 computation, this 25 is just an assumption because 2021 is yet to happen. Okay? So in 2021, your number of employees na nag-leave sa 2021 has already ascertained in the number of 22. So that means the number that we will be deducting here is also 22, the actual amount of employees na nag-leave sa 2021. Thus, giving the corporation a remaining 420,000 employees eligible to receive your share options. Okay? So you have 100 share options per employee. So 420 times 100, so we have 42,000. Multiply it by fair value na 30. Okay? So your total compensation will be 1,260,000. Okay? So 1,260,000, just like what we have done in 2020. So that's 1,260. That 1,260 is actually for the entire 3 years. So since we were able to recognize already in 2019 and in 2020, so what we need to do is simply to deduct the total amount of your compensation expense that is already recognized in 2019 and in 2020, which is a total of 834. So that gives us a compensation expense for 2021 na 426,000. Okay? So pagka 2021, the compensation expense that will be recognized by the entity will only be 426,000. Okay? So again, just like the previous years, same pro forma in your journal entry, debit to your salaries, share options, credit to share options outstanding for 426,000. Okay? So that's how are we going to compute for your compensation expense for 2019, 2020, and 2021 when there are employees who actually left the corporation. Okay? So this time let us proceed with another illustration. Okay? This time there is a condition. Okay? There is a condition to be met before share options can be distributed to the employees. Okay? And these share options, depending on the condition, will also vary. Okay? The total number of share options to be distributed will vary depending on the achievement of the condition. Okay? Example, on January 1, 2019, an entity granted share options to each of the 300 employees working in the sales department. Alright. The share options vest at the end of a 3-year period provided that the employees remain in the entity's employ and provided the volume of sales will increase by an average of 10% per year. Okay? So the fair value of each share option on grant date is 20 pesos. So we will still use fair value method here since fair value is given. So let's determine first the condition. So the condition before share options can be given to the employees, the volume of sales should increase by an average of 10%. Okay? So that means if the volume of sales will increase less than 10% per year, then that means your share options will not be vested. Okay? Or I mean, will not be given or will not be distributed to the employees. So before they could enjoy that share options, they should make sure that their sales volume will increase for an average of 10% per year. Okay? Before they could enjoy that share options. And then another condition, if sales increase by an average of 10%, each employee will receive 200 share options. Okay? If 10%, then each employee will receive 200. If the average increase is 15% per year, then therefore each employee will receive 300. Okay? So the condition is changing and the share options also varies. If 10% lang, then the employee will receive 200. If it's 15%, then 300 share options will be distributed. Okay, here's what happened. On 2019, the sales increased by 10% and the entity expect this rate of increase to continue in the next 2 years. Okay, so that means 10 plus 10 plus 10 divide 3. So that means 10% average for 2019. Pasok sa condition. In 2020, the sales increased by 20%. Okay? So that means 10% from 2019 and 20% for 2020. So that means 20 plus 10% divided by 2 years. So that means the average increase is 15%. So in this case, in 2020, okay, the employee will receive 300 share options. And on 2021, the sales increased by an average of 16% over 3 years, okay, by the end of 2021, and there are 20 employees who left the entity, okay. So let us compute now the compensation expense to be recognized per year. Okay? Since it has a vesting period, so therefore, we can't recognize entirely the compensation expense on the grant date. So as what we have discussed earlier, it will be recognized starting from the grant date, staggered basis up to the day where it is available for exercise. Okay, so in this case, 3 years. Okay, so number of employees, there are 300. Okay, so multiply by share options per employee. Okay, the condition, guys, is to distribute 200 share options when the average increase is 10%. And obviously, in 2019, the average increase was 10%. Okay, 10% pagka 2019. So that means the employees will only be receiving 200. Okay, 200 share options. So that means there will be 60,000 total share options to be distributed. Multiply it by the fair value of 20 pesos. So total compensation will be 1.2 million. All right. So divide it by 3 years, vesting period. So that means for 2019, your compensation expense to be recognized will be 400,000. Thus, journal entry again for 2019 will be debit to compensation or salaries, share options, credit to share options outstanding for 400,000. All right. Now let's proceed with 2020. On 2020, take note that the increase on 2020 was 20%. If you average it with the previous year, pagka 2019 na average increase or increase in sales, so that's 10% plus 20% in 2020. So 10 plus 20, that's 30, divide 2 years to compute for the average. So that gives you 15%. And that means the employees will be receiving 300 share options this time since um they have knocked the condition to receive 300 share options. So from 200, it will be multiplied to 300. Okay? So the total share options to be distributed to the employees will be 90,000. So 90,000 times the fair value of 20 pesos. So therefore, we'll have 1.8 million. All right. So this 1.8 million is also for for the for 3 years. So we need to compute kung pila lang ang cumulative up to December 31, 2020. So you need to divide it by 3 and then multiply it by 2 years to compute for your cumulative compensation on December 31, 2020. So that gives us 1.2 million minus the amount you have already recognized in 2019 na 400,000. So therefore, your compensation expense to be recognized in 2020 will be 800,000 na lang. Alright? 800,000. So on 2021, what happened in 2021? There were 300 employees, but there were 20 who left the corporation. So that means the employees entitled to receive share options will be 280 na lang. Alright? 280 na lang. And the condition on your or the average increase in 2021 was actually how much? That was 16%. So since that is 16%, so um that means it is allowed or it is to receive 300 share options. So 280 times 300, so we have total share options of 84,000. Multiply it by fair value na 20 pesos. So therefore, your total compensation will now be 1,680,000. 1,680,000, so that's good for 3 years. You need to deduct those compensation expense recognized already in 2019 and 2020 for you to compute the compensation expenses only good for 2021. So in this case, we were able to um, recognized already from 19 and 20 compensation of 1.2 million. So the amount to be recognized na lang in 2021 will be 480,000. So on 2021, we will be recognizing 480,000. All right. So in 2021, the journal entry at the end of the year will be debit to salaries, credit to share options outstanding for 400,000. All right. So in that case, um, the number of shares would depend, or the number of share options would depend, depending on the condition, no? If they have met the condition or not. So generally, the computation on, or the accounting for your share options, or your share-based compensation through share options is just really simple, no? You really need to just simply be considerate on the timing and as to the amount to be recognized. All right, now let's proceed. What if this time the fair value of the share options is not given? Okay, so the standard has mentioned, if it is not available, if the fair value is not available, then we will use your intrinsic value. Okay? So example, on January 1, 2019, an entity granted 10,000 share options to employees. The share options vest on December 31, 2020. Okay? So that means there is a vesting period, no? 2020, so that means there's 2 years vesting period, provided that the employees remain in the service until then. The fair value of the share options cannot be estimated reliably, so that is why we will use the intrinsic value method. The par value per ordinary share is 100 pesos, the option price is 125, and the market value of the ordinary share is also 125 at the date of grant. So all shares options vested on December 31 and no employees left the entity. So that means all of the employees were able to receive share options on the date of grant. Okay? So the share options can be exercised starting January 1, 2021 and will expire 2 years after. So 2 years pa after, they will have leeway to make muni-muni whether they will really be exercising that share options. Okay? All share options were eventually exercised on December 31, 2021. And the share market prices are 150 on December 31, 2019, 180 on 2020, and 200 on 2021. Alright. Now the standard provides that if the fair value of the share options cannot be estimated reliably, as mentioned earlier, the entity shall measure the share options at their intrinsic value. Okay? Take note that your intrinsic value, this is the difference between your market price and your option price. Okay? Your option price is 125 and your market price will differ depending on the date. Okay? Market prices are available, no? So you need to compare it to compute for your intrinsic value. Also, subsequently, at each reporting date and at the date of the final settlement, with any change in intrinsic value recognized in profit or loss. So any intrinsic value that is the excess of the market value of the share option. Again, your intrinsic value, this is the amount or the difference between your market price and your share option. Okay, so in this case, let us compute for your share options. Salaries for or compensation expense, guys, salaries expense or compensation expense are just the same, ha? Do not be puzzled. You can use compensation expense in lieu of salaries here, or you could use salaries, no? It's just the same. Okay, on 2019, so let us compute for the um intrinsic value of the option. So you have the market value on December 31, 2019. So that is from here. This is 150 versus your option price of 125. So that means your intrinsic value will be 25 pesos times the total number of share options. There were how many share options now are given to the employees? 10,000. So therefore 10,000 times your intrinsic value of 25. So 25 times 10,000. So your total compensation will be 250,000. And that 250,000, guys, since this is a vesting period, there is a vesting period that will be divided throughout the vesting period. In this case, this is 2 years. So 250 divide 2 years, so that is 125. Okay, 125. So your journal entry will be debit to salaries, share options for 125, and then credit to share options outstanding for 125,000. So again, here, the timing will just be the same, but as to the amount, you need to analyze. Okay, whether not really analyze, but you really need to consider when to use intrinsic value. Then there is only one thing to consider for you to use intrinsic value. When there is no fair value, then that's the time for you to use intrinsic value. Okay, and the computation of your intrinsic value is also very simple. You just simply compare your market value and your option price to compute for your intrinsic value. So in this case, you'll have 125 na total amount of your salaries expense. So debit to salaries expense, share options for 125, and then credit to share options outstanding for 125,000 as well. Okay, now let's proceed for 2020. Now take note, guys, we can't use 125 for 2020. Why? Because your intrinsic value will change. Okay, from 25 pesos na intrinsic value on 2019, you will now have 55. Okay? So 55, that is from 180 na market value on December 31, 2020 versus your option price na 125. So that means your intrinsic value will be 55,000. Multiply it by the total number of share options to be distributed. So you'll have 10,000. Okay? 10,000 times 55 pesos. So you'll have your total compensation of 550. Okay? So 550, that is good for 2 years already. So since you were able to recognize na 125 for 2019, so that means your compensation expense for 2020. Okay? So your compensation expense for 2020 is 425,000. Okay, so your journal entry here will be debit to salaries, share options for 425,000, credit to share options outstanding for 425,000. Okay, so immediately on 2021, the um, recipients of your share options can now exercise that share option. Pero take note, guys, when there is a change in your intrinsic value, and if your share options are not yet exercised, so the change in intrinsic value would automatically be considered as an additional salaries expense or additional compensation expense. Okay, for example, when was your share options was exercised? Okay, kanusa daw na-exercise ang imuhang share options? It was exercised on 2021. Alright? It was exercised on 2021. Okay. On December 31, 2021. So it can be exercised starting January 1, 2021 up to December 31, 2022. Kaya there are 2 years man na prescription period. So in this case, since nag-change man ang ato ang intrinsic value, okay, before siya na-exercise. So, before siya ga-exercise, 180 pang intrinsic, ang market value nato 180. And then the exercise date nato is 200 na ang yang market value. So that means there is an increase in intrinsic value. So that increase in intrinsic value, guys, that will be considered as an additional compensation expense. Okay, that is considered as an additional compensation expense. So debit to salaries, share options. Excuse me, this is not 425, guys. This is 200,000. Okay, this is not 425, but it is only 200,000 to recognize for your additional compensation expense. Credit to share options outstanding also for 200,000. Okay? So to compute or to account the exercise, okay? So there are 10,000 shares times issue price of 125. Your issue price is 125 per share, so 10,000 times 125, so we'll have 1,250,000. And then you close your share options outstanding. So you have total share options outstanding of 750 pesos, 750,000. So where did we get that 750,000? So that's actually from 125,000 in 2019, 425,000 in 2015, and that 200,000 additional salaries expense or share options outstanding on 2021. That makes it 750,000. And then credit to ordinary share capital for 1 million. So that is from 10,000 shares times par value of 100 pesos. So that's ordinary share capital of 1 million. And then credit to share premium for 1 million also, which is, the difference between 2 million minus 1 million na ordinary share capital. Okay? So this will be your pro forma journal entry when we actually use your intrinsic value method. So intrinsic value method can be used again when the fair value is not available. Alright, now this time let's proceed with acceleration of vesting. So from the term itself, acceleration of vesting meaning you fasten, no? You fast forward the vesting period. So the standard provides that if an entity cancels or settles a grant of share options during the vesting period, the entity shall account for the cancellation or settlement as an acceleration of vesting. So that means the entity shall recognize immediately the compensation expense that otherwise would have been recognized for services received over the remainder of vesting period, or any payment made to the employee on the cancellation or settlement of grant shall be accounted for as repurchase of equity interest, meaning and deduction from equity. Okay? So if the payment exceeds the fair value of the share option, then the excess will be recognized as an expense. Okay? So to account this concept of acceleration of vesting, let us use this into an illustration. Okay? So let us have here on January 1, 2014, or this is actually 2019, or let's use na lang this one, 2014. This one is 2014 and this is 2015. Okay, this is 2014 and this is 2015. Okay, on January 1, 2014, an entity granted 50,000 share options to the employees. The option price is 60 pesos and the par value of each share is 50 pesos. The vesting period is 4 years and the fair value of the share options or total compensation expense to the vesting date on December 31, 2017 has been calculated at 4 million. Okay? So, you have a total of 4 million. The entity has decided to settle the award early on December 31, 2016. Okay? December 31, 2016. So the compensation expense charged in the income statement since the date of grant on January 1, 2014 were as follows. So on 2014, we were able to recognize na 1 million. And on 2014, 1 million, 2015, 1 million 50. So from 4 million, okay, from 4 million na total compensation expense, how much is left? Or how much is the difference? Okay, so that's 4 million minus 1 million minus 1 million 50. So that's 1,950,000 na remaining compensation expense to be recognized. Now, if the share options are cancelled or settled during the vesting period, it is as if the vesting date had been brought forward and the balance of the fair value not yet expensed is recognized immediately. So, that means from 4 million, minus 1 million and 1,050,000 which were already recognized in 2014 and 2015 immediately or respectively, the remainder of 1,950,000 will be recognized as compensation expense on December 31, 2016. Okay? It's as if na ang total remaining compensation expense which was not recognized yet will be recognized in full on December 31, 2016. Okay? So in this case, guys, you have here 4 million minus 2,050,000. So that means there will be a compensation expense of 1,950,000. Okay, 1,950,000. So that means on that date, on 2016, okay, there is actually an error on dates here. So this one, 2021, this is pertaining to 2016, 2019 is 2014, 2020 is 2015. Minus 5 years lang ito sila, guys. Okay? So, what's important is the figures. Okay? So, on 2016, that means the remaining amount of compensation expense which was not recognized yet. So from 4 million, 'di ba? Your compensation expense for the entire 4 years vesting period was 4 million. You were able to recognize already for the first 2 years na compensation expense of 1 million plus 1,050,000. So that means the remaining compensation expense will be 1,950,000. So when there is an acceleration of vesting period, instead of having 2 more years, gi-advance siya nga pwede na daw siya i-avail or i-exercise at the end of 3 years. So that means the remaining 1,950,000 will be recognized in full on that date. Okay, or on 2016. So that means we'll have debit to salaries expense for 1,950,000, credit to share options outstanding for also 1,950,000. Okay? Dapat ang imuhang total salaries expense or compensation expense will now be recognized. Alright? So if the share options are now recognized or exercised on December 31, 2016, your journal entry will include, obviously, debit to cash equal to 50,000 times the issue price of 60 pesos. There were 50,000 shares. So that's 3 million. And then your share options outstanding for 4 million. Credit to share capital, 50,000 shares times par value of 50 pesos. So that's 2.5 million. And then credit to share premium for share premium for 4.5 million. Okay, now suppose that the share options are not exercised. What if the share options are not exercised? Instead, the entity paid the employees 2.5 million on December 31, 2016 to cancel or settle the share options. Okay? The following accounting procedures will be followed. Number one, any cash paid up to the fair value of the options or cumulative compensation already recognized is deducted from equity or charged to share options outstanding, and any amount in excess of the fair value already recognized is treated as an expense. So in this case, guys, for example, when there is a total of 2.5 million na settlement, okay, pila man ang atuan nang na-recognize, pila na ang atuang na-recognize. Ang atuan lang na-recognize pa lang is 2,050,000. Okay? Kadto lang 1 million and 1,050,000. Okay? And then, after that, gi-cancel ni corporation. So, that means, that 2,050,000 guys will be charged to share options outstanding. So, debit to share options outstanding for 2,050,000. And then, the excess sa 2.5 million will be charged to expenses or will be charged to salaries expense for 450,000 and then credit to cash for 2.5 million. Okay? So again daw, what if wala siya gi-exercise and then gi-cancel na lang ang gi-cancel na lang ang share options. So kung gi-cancel na lang ang share options, what if naghatag og 2.5 million ang corporation from that cancellation. So ang 2.5 million, how are we going to account? First, gikan sa gikan sa um, total amount we already recognize as compensation expense, which is 1 million plus 1,050,000, that will be charged to share options outstanding. Okay? So debit to share options outstanding for 2,050,000. And then the difference nga 450,000, the difference of 450,000 will be credited to salaries for 450,000 and then credit to cash na 2.5 million. Okay? So if ever guys, if ever the share options were canceled. Okay? So I think that would be the end of our lecture for um, share-based compensation, particularly on share options. So if you have any more questions, clarifications, or positive thoughts regarding the subject matter, you can actually comment down it below our for immediate response, or you can raise it during our virtual class. And for your information, you could also refer to these materials for more information. Okay, so that's it for this day. Thank you very much for watching, and God bless.